So let's look back at your combined. What's an item that you would want to purchase that's under 180
Um,
that you might have paid cash for otherwise, or you might have gotten a loan for otherwise?
let's say I buy a house in Mississippi or Alabama.
Okay. And how much does that house cost? 150?
Yeah, 150.
Okay. And how many months is that going to be out?
Well, typically the going rate right now is eight, 8.5.
Yep, for a an investor loan, yes.
And
Okay.
then let's do a 15-year, 180.
Okay. All right. So obviously you understand that the first year you've paid in 12,000 in interest cumulative, in the second year 24, blah blah blah, all the way down to you've paid it off and you've paid an extra 115,000 in interest. So the total cost of that home over 15 years, 265,000.
Mm-hmm.
Okay. Let's go put in the numbers you've got here. 5.2 versus 5.0. All right. So same amount of time. Your 150 here is going to grow in 5 years to 194, increasing by 44,000. In year 10, it's grown to 252 or 102,000. And in year 15, when you've paid that off, your 150,000 has now grown to 362. So in this case, you have 362 still in the bank and you got the house. And it's grown by 176. Now you borrowed from the insurance company, you borrowed the same 150, and if you were paying down on it the same way as though it was a structured loan, even though, as you know, it's not a structured loan, it's non-structured,
Mm-hmm.
but your cumulative interest there at 5.0 is 7,000, then 14, then 20, etc. And after 15 years, you've paid 63,000. So this is what I'm doing up here. The ending balance of your cash value is 326,000. The amount that 150 has earned at 5.2 has turned into 176,000. But because simultaneously you had a loan from the insurance company that you've paid 63,000 in interest on, you have
Yeah.
an arbitrage of 113,000. So over that 15-year period, you just bought a $150,000 home for 36,844.
Um, you lost me on that one.
Okay,
Move. Can you move the? It's I'm right over those numbers.
this.
Yeah, the picture.
Okay, sorry, right there. So over
Maybe
15 years,
just a sec. It's me. Okay. Okay. So okay, the ending balance of 60 money grew. And is that 5.2? Is that like a fix, or does that adjust with the market?
it doesn't necessarily, the answer is yes, it adjusts with the market, but it adjusts it not because of the market. It adjusts not with the market or because of the market, but uh, macro market effects are going to change it. So each year they come out and they say, this is what we're paying this year. So right about now, last year, the company came out and said, we're going to pay 2023 5.2 again. So obviously interest rates have gone up, so the insurance company can now lend out money to others at higher rates than they used to. So my guess is this year they're going to move it up from 5.2 to some other rate that's a little
So it
higher.
adjusts.
But it is fixed for 1 year at a time. So it's not like what you're used to as a loan officer where it changes on a daily, hourly basis. They set that guaranteed rate for an entire year at a time.
And then what about the interest paid to the insurance company? Does that change?
It also changes, and again, it's due to the profit and loss. So here's the thing that we have to keep in mind here.
Is is this arbitrage an odd scenario?
This one right here that I'm showing you, yes, it is. It's usually, like I said, like with my policy, the delta is a negative. It's a negative 50 basis points. So let's just throw my numbers in there, just so you can see what happens there. So 4.25 would probably be more in line with what it usually is. Yes, this is an odd scenario right now. 4.76, good point. So even so, if this were my policy, and I'd get you into this one because this company's paying out better right now. But the company I'm with, I'm getting paid 4.25, and if I want to borrow, it's 4.76, which means that over 15 years, getting paid 4.25, my 150 is going to grow to 283, or it's going to grow by 133,000, right?
Right.
And then paying 4.76 down my cumulative interest that I pay down over 15 years is 60,000. So I still end up with a positive arbitrage over the 15 years of 73,288. So the total cost of that home, if you take 150 and you subtract the 73, I think that was the question you had a minute ago, how did I come up with that number, would still be 76,000.
Yeah, that's amazing. That's the amazing part to me. So, 'cause when you just go over, when you just show like this as a savings plan, to me it doesn't seem like a very good. I mean, you buy insurance, sure, but it doesn't seem like a good savings plan because, like, say put in 200,000, savings immediately goes down by 26,000. Because I'm buying insurance.
Right. But when
But
you
if I'm
show using it as a bank, it becomes a different thing. Yeah.
yeah. But when I'm actively using it for really any kind of asset, especially some kind of cash flowing asset, then it becomes an amazing product, an amazing tool for building wealth.
Exactly.
Okay.
Yeah. So I'll go back to the numbers
that,
are
that
actual
more
right now.
than, yeah, that more than, I mean, that the total cost of the item, 36,000.
Right.
All things stay the same, so to speak. But yeah, that makes a ton of sense, actually. I wish I had a couple million to put into something like this.
Yeah, that's the point. Well, I don't know if I told you this, but when Mark first approached me, or when I saw his ad, and I called him, and then he said, "Well, the first thing to do is get you your own, account so that you can do this." And I said, "Wow, this is cool." Now, well, you'll understand this because you're a loan officer. So CMG, they're all-in-one loan.
Mm-hmm.
I already understood the power of the all-in-one loan where it amortizes on a daily basis, except you're paying them interest, but who cares if it's amortizing and you're putting your bank check in there, then you're paying off your home in 15 to 17 years instead of 30, even though it's a 30-year note, and it's a higher interest rate, but who cares? You're paying it off faster, so you pay less interest over time. So I understood the mechanics of the CMG all-in-one loan, and so when I saw this, I was like, oh my heavens, this is the CMG loan, except instead of paying for my HELOC, I'm getting paid on my HELOC, And
Right.
I went back to Mark because he built me one, and he said, well, we'll get you completely out of debt in I don't remember how many years it was, but it was like 7.8 years or something like that, paying in about $700 and something a month. But as soon as I understood the math, just like you said, well, I wish I had $1 million to put into this. That's exactly what I did. So I came back to Mark after the first morning of training, and I said, hey, I don't want a $700 policy. I want to put in $5,000. No, I said, I want to put in $9,000 a month. He goes, slow down, cowboy. Glad you understand the math. Most people don't get it, but let's just do something more realistic. And we landed on 5,000. So that's why I started putting in 5,000 a month, was because I understood the math.
Yeah. No. Yeah, it makes sense.
So let me take it to the next step. So this is where I call being an honest banker. I know that's an oxymoron, but let's throw this back. These are the combined numbers for you and your wife. So you'd have 180 there. So let me just give you a scenario anyhow, just for the kicks and giggles of it. Let's say that in year one, you want to do a fix and flip. And let's just say that you assume that you'll have that thing fixed and flipped in 2 years. And you want to take out 150,000, again, that same home in Mississippi or wherever you said. But this time you're buying it distressed. It's 75,000 distressed. And you're going to put 75 into fixing it, and then you're going to turn around and flip it. And again, let's go with the traditional market rate of, well, what would hard money be for a fix and flip right now out there?
I haven't even checked, but I mean,
Probably 11.
I'm sure 12 or 14. Yeah.
Okay, so let's just go 12. Okay.
Be typically interest only.
Yeah, because okay, and in this case, this isn't even interest only. You don't have to make any payments, but. So here's what we end up doing here is now here's the concept that I throw to people. I say, okay, so first of all, this is a non-structured loan. So you don't have to pay it back, even though this is calculating that you'd need to pay 79 in year one and 79 in year two to pay that back. Or you'd have to make payments on it of $7,396 a month to pay back the traditional loan rate of that. But since you're actually getting this at a positive rate, you'd only have to pay $75,000. Here's the point I want to make, though, is that what I tell people is now be that honest broker. This 12% that's the going rate for hard money, pay yourself back that money. So now at the end of this time frame, you could pay yourself back the 13,755, which is what difference, instead of just the 75,000, you're paying yourself back that 13, and you've also got the increase in your 150, which has grown by 7,000. Now you've got a delta there in year one of 21 grand that you shove back into your policy because you chose to be an honest banker. In
Right,
the
right.
second year, you'd make 22. So really, over a 2-year period, if you were doing this, bingo, there you go. You've just put an extra, your cash value, which is what it's illustrated at, would have been 209, but now it's at 223, just by, taking the money out of your own bank account. Or let's just
Right.
do it this way: let's just do the 1 year, because a fix and flip, you wouldn't really have to make it happen faster than that. So again, if you figure in the cost of the money at 12%, which would be 18 grand,
Oh,
pay yourself
plus you
back.
pay like 2 to 5 points up front.
Oh yeah, just to get the loan.
Yeah.
Yep.
Yeah, conceptually this is amazing. Yeah, I could see. I really do need like $3 million. Then I could start loaning it out.
Well, that's the point. So this is what Diane and I just did. I think I told you that. Our daughter, I'll just run the numbers here just so you can see it. So our daughter and son-in-law, the guy next door was having a yard sale, and the guy asked, somebody that was buying something said, "Why are you selling all this good stuff?" And he said, "Oh, my wife and I are getting out of the Army, and we're retiring, and we're just buying an RV, and we're just going to travel around in the RV. So we're selling our house, and we're putting it on the market Monday." This was a Saturday. So as soon as that guy that was trying to dicker him on price on something walked away, I went running over to the guy and I said, "Hey, his name's Jason." I said, "Hey, Jason, you're both Army. Did you get a VA loan?" He goes, "Yeah." And I said, "So it's assumable?" He goes, "I don't know." I said, "Well, I can guarantee you it is." He goes, "Okay." I said, "So how much do you want for the house?" And he gave me the price. And I said, "Do you have a realtor involved yet?" And he said, "No." And I said, "So if you put a realtor in there, that's going to cost you another 26,000. Just did the simple math in my head real fast, right? He goes,
Right.
"Yeah." And I said, "So how much do you actually owe?" And he said 298 or something like that. Let's just say 300. And I said, "Okay, so really all you're trying to do is put 20 grand in your pocket." And he goes, "Yeah, 21 is what we're figuring we can get." I said, "Okay, 21. Let's go with 21. If Diane and I give you 21,000, would you allow our kids who are also in the military to assume your loan?" He goes, "Well, if they can, I don't think I got a problem with that. Let me talk to my wife." And I said, "Okay." He goes, "Well, we have to put together a contract." I said, "Yeah, we'll put together a contract." So Diane and I, they wanted some of their appliances and stuff in the house too, so we gave them 30. But let's say the term is 5 years. Oops, 30. So we go to our kids and we say, we're going to do this for 5 years, and we're going to put this at a rate that's fair to them. So what would you say is fair to my kids?
Yeah.
5.5?
Sure.
Okay. So now my kids get to pay us a payment of $558 a month to pay that 30 grand off. And really all they're going to do is they're just using us as a bridge loan until they sell their house, because they've got 30,000 in equity in their home. As soon as they get that, they're just paying us off. But you get the idea now. Now I've
Right.
become a banker for my own kids.
Cash value increase. It's growing. The insurance loan balance goes down.
Yep.
Even at market rate. That's annualized, right? 7,000.
This is at the 5.5.
Oh, okay.
That's at the 5.5. Good point. So I should have walked through this. So the
No, that's okay.
cash value
Okay.
increases on my 30,000 up to 38,000 over 5 years. Obviously, if my kids were actually making payments to me at 500 a month,
So you
or
pay back
five-
so the net is, a compounding interest. You get the compounding interest on your 1,025 that's in additional to just paying back the loan.
Exactly.
Okay. So then then that shows your honest banker increase.
Right, because I've now become a banker to my kids, because the real cost of that money to me is actually a positive 20 basis points. So it blows up the formula. But really, it's not costing me anything, because I can borrow at 5 and they're paying me 5.20. So really, I'm making off of my kids that interest of 5.5%, which is $1,000 a year, plus my 30,000 is still growing by that number there each year. So 1,598 the first year, 1,683 the second year, etc. So if I add what I'm making from my kids' payment to me between my cost of goods, so my cost of goods for this loan is a positive 20 basis points. That's what this is how much it's costing me to lend out money to my children. And then the actual increase in my policy over here. So that gives me a total net private equity banking plus cash value growth in arbitrage of 2,623. And if they were to pay it back over 5 years, I'd have made 14 grand extra.
Yeah. Yeah, math's amazing, right? When it starts to work in your favor.
Well, and that's the whole point, is when you're paying a bank interest, when does it work in your favor?
Yeah, it's not. Yeah,
And when when you're your own bank, when is it in your favor? That's really all this is.
yeah, so I can see like um yeah, because when you're first telling me about it and I'm just looking at the insurance, like just as a place to park my money, like it's really not that great to me. But if I'm starting to use that money for some kind of positive thing, then it becomes an amazing tool.
Okay, and so one of those things, again, knowing what you do for your side hustle, buying houses, where else can you get money at 20 basis points positive or even 50 basis points negative and use
Oh
that
yeah,
money in a non-structured loan where you close on that loan with no basis points and you pay it back never or whenever you flip the home or whatever, you know what I mean?
right, right. Yeah, no, I mean, there's nothing, there's except for being your own actual having a bank where you make money out of thin air.
Yeah,
There's really not anything comparable.
right.
Um, I think once someone puts this in place and like really conceptually understands it and then starts to do it, like to know that you're going to earn interest on the value of your investment. Then when you borrow that money, that well, you're going to earn money. You're going to earn interest on what you borrow, and then you're going to pay that back, and you're going to continue to earn interest on what you borrowed. And then once you've paid it back, you still have the asset. You still have the um,
Right.
original principal input. Plus, you've earned interest. Plus, you've earned the gain on whatever project you've done. Like
Yep.
it's it's kind of amazing though when you think about it. Like try to, I guess, use my own words to explain this thing.
I'd love to hear you choose it. You're the one that's the financial guru, not me. I'm just a dumb bunny. I got
Uh,
an MBA. I don't have a degree in finance.
I don't think so. I think you're pretty intelligent when it comes to this stuff. Um,
Well, I don't have a degree in it like you do. But isn't that amazing? You've got a degree in finance, right?
yeah,
And you were never taught this.
never. I mean, I remember taking college calculus and listening to an Asian teacher talk about a Roth IRA, how you could grow tax free and then take the money out tax free. And he was like, in his broken Asian English,
Yeah.
it is a gift from God. And what's funny about this is I actually understand for my own research, just understand more of the banking process, like just how ridiculous it is.
Right.
And I've always thought, like, one of the best investments would be to start a bank.
Right.
I mean, where else could you put $3 million in and then lend out 30 million and then lend out another 30 million based on the cash flows coming in from
Right.
the first loan and keep doing that forever.
And see, now we get back to the trust. And this is something that you had already said, your exit strategy. But here's where we figure out how to get these trusts so that when Will passes away, the trust is the beneficiary, and then the trust instructs that $2 million that just came in at tax free. And it says, okay, each of my children, this is going to buy a 2-pay on each of my children at this percentage or whatever, right? And so each of the kids gets a 2-pay policy. So there's enough cash there. So there's 2 million. In theory,
Oh,
you're putting $1 million in year one. You're putting $1 million in year two for each child or for total sum. So, however many kids,
so you set up a bank for them.
right. It forces them. And then after the second year, they're allowed to borrow back, say 25% or something like that. But now the beneficiary of their life insurance policies has become the same living trust. You're already gone, but now all of your kids have one, and when they pass away, the money comes back into that trust, and their kids have to buy policies on them, and you've now spread the wealth, and they call it the waterfall method. That's what the Rockefellers do to enrich their generational wealth. That's how they do it.
Yeah, that's fascinating.
Yeah.
So, I think I heard someone try to explain it. He's some financial guru. He was trying to explain that, but he didn't do a very good job, I don't think.